Hey everyone, me Kevin here. For every $100 that exists today, as of December 15th, 2020, governments and banks around the world created $20 out of thin air in just the last 11 and a half months. This could be really bad. So in this video, we're going to talk about what this means for our money and how bad this actually might be. But just keep in mind, in the meantime, that if you want to learn everything I know about building wealth, make sure to check out the amazing programs down below on building your wealth with real estate or stocks or both together. There's some great opportunities for you and love for you to be able to use that holiday bundle coupon code by emailing me at kevin@meetkevin.com or just use the single purchase code in the description down below. All right, first, let's talk about money and the biggest problem facing it right now, which is one of the reasons that people are fleeing to Bitcoin. And we're going to start off very simple in this video, and then we're going to get a little bit more complicated. So if the first 30 seconds to a minute here start sounding basic, don't worry, we're going to get deep pretty fast, so buckle up. The easiest way to picture the problem of what I'm about to say is, well, basically say, let's say you have $100. So since I don't have $100 in cash, I drew this. A picture of $100. So let's say that this $100 bill can buy you 100 pencils today, December 2020. But you choose not to buy the pencils and instead you put the $100 in your drawer. Next year, you take this out and you say, hey, I'm gonna go buy pencils. But now, the same $100 bill only buys you 98 pencils. You got stiffed for 2 pencils, about 2%. That's inflation, we know that. We're gonna go pretty deep on this here. See, even though your paper still says 100, you got less stuff for the same piece of paper that you had last year. And that sucks. See, this sort of devaluing of our money can happen in 2 ways. Sometimes things get more expensive to make because maybe people are getting paid more money because there are fewer workers and prices go up. That's not good. And when prices go up, again, we're buying less pencils with our $100. And that can sometimes be a little bit ironic because, like, pencils should be easier to make over time. I mean, think about it. Somebody's probably made a faster pencil machine, or we'll just stop using as many pencils and we'll use computers and keyboards. That's normal. This is what happens when technology actually normally drives prices down. But see, we're in this really weird world where central banks and governments around the world say, you know what? Even though prices are supposed to go down with technology, we're going to do whatever we can to make sure that prices either stay stable or go up, which means you're able to buy less pencils every year that goes by. And that's kind of weird. One of the ways they do this is by basically just printing more of these currency items, dollars or $100 bills, that we trust. And that's pretty much all we have when we have a piece of paper that's called money, and it's trust. We trust in our government and our central banks that they're not going to completely ruin the value of this for us. And if they do, well, then we'll see inflation. And see, a recent example we could look at for this is actually Venezuela or even Zimbabwe. Their currency basically collapsed because the people lost trust in their governments, setting in hyperinflation. Imagine this. Today, your $100 buys 100 pencils. Next week, it only buys 50 pencils. And in 1 month, you can only buy 5 pencils for your $100. That's bad. That means your ability to buy pencils is evaporating really fast, and that creates depression, fear, anger, riots, civil wars, and there are a lot of people worried right now that what if we see hyperinflation in America or around the modern world, kind of like what we saw in Venezuela or Zimbabwe recently, or even maybe going back to the Weimar Republic in Germany, where guess what happened after the Weimar Republic and people are wheeling around wheelbarrows of cash in Germany just to go buy a loaf of bread? Well, you introduce the lead-in to the Nazi government. All right, let's take a quick pause here because we're going to transition in this video. So the first thing that we learned is, well, inflation makes the trust me dollars go down in value. They're able to buy less pencils. And this is weird because technically technology should be making things cheaper. That's a natural process. Yet they're not. The governments and central banks, they want inflation. And we also know that governments and central banks literally created 20% of all the currency that exists today, which is absolutely insane. If there's anything you take away from this video, it's that when you look at your next $100 bill or even $5 bill, realize that 1/5 of that, so $1 out of 5, $20 out of 100, were magically created in 2020 thanks to the pandemic. Okay, so that's what we just picked up and learned. But what is this going to mean going forward? Well, this is really important, and this is something that we should really consider marking on our calendar because you are going to get inundated with clickbait in March, April, and May of 2021. That's because in March and April of 2020, we had really low inflation readings. And so when we do a year-over-year comparison and we get to March of 2021 and we look back at March of 2020, we're gonna go, oh my God, look at all that inflation that happened. Kind of a little fugazi. The current measures of inflation are actually really low. And so this is where we're gonna talk in just a moment about our expectations actually going forward. But I just wanna clear the air here preemptively again in December that you're going to see a ton of clickbait in March, April, and May about crazy high inflation. Just as an example as to how this would work, let's say pencils usually sell for $1 per pencil. And in March of 2020, because of the pandemic, the pencils sell for 95 cents. So 95 cents would be the cost of the pencil in March of 2020. But then we have, let's say that we go back to normal and then we get 2% inflation in March of 2020, then that pencil might cost $1.02. But if they compare March to March, that actually looks like a 7-cent difference in pricing, which could look like 7% inflation. Now, I'm not expecting to see headlines that are like, oh my God, 7% inflation, but I am expecting to see headlines that say, holy smokes, we're gonna see 2.5% to 3% to 4% inflation all over the place in March, April, and May. I'm telling you it here in December because you gotta mark your calendar that when you see that, that's just a distraction. That's fugazi. That's going back to normal. That's not what we're actually wanting to be worried about. Instead, let's understand the three main things that actually cause inflation. First, inflation can be caused by a ton of demand. And researchers today, particularly as it relates to this pandemic, have found that there tends to be a surge in demand for goods and services after a pandemic as people are anxious to get out and spend and go back to normal. This was studied after the Spanish flu in 1918 to 1920, and it was studied after other pandemics as well. Harvard did the research on the Spanish flu, The Economist talked about other pandemics, so this is normal. And if we get a surge in demand for goods and services, we could see prices go up. And that's when we could see that inflation and the loss in value of all of this. And it makes sense because household wealth just hit its highest level ever in the United States. And that's weird because, again, we're in a pandemic and many people are suffering. But aside from the many people who are suffering, there are many people who have a lot more money than they used to have. Well, again, 20% of money was just created out of thin air. It's kind of like somebody threw a bunch of money up in the air and everybody's trying to get their piece. This could lead to inflation. Number two, inflation can also be caused by worker shortages as some people retire and we get back to normal levels of employment. Well, right now, we think that it's probably going to take, and by we, I mean the Federal Reserve, we think that it's probably going to take until 2023 to 2024 to actually see normal levels of employment. And certainly until we start seeing full levels of employment, which is when all minorities and women are also fully employed, we might not get there until 2025. So while inflation can be caused by worker shortages, we're probably not going to see those worker shortages just yet. We're probably going to see more inflation as a driver come from a surge in demand as people go back to using more goods and services. So far out of 1 and 2, we're not seeing worker shortages that are going to lead to inflation just yet, but we are seeing prices of travel actually go up, especially as airlines have less planes available for more and more people trying to start traveling again. So we're seeing prices in food and air travel go up. But other than these two sectors, not yet seeing inflation from a surge in demand for goods and services, which makes sense because, well, we're not out of the pandemic yet. Okay, so reason number 1, more demand for goods and services. Reason number 2 to see inflation would be worker shortages. Probably going to be a bit before we see that. And then reason number 3 could actually be caused by, well, a complacent central bank. The Economist says that if basically complacent central banks that just keep printing money and injecting money into the economy can force inflation. And I mean, think about this. We had 20% of the world's currency created in a matter of 11.5 months. So this kind of makes all 3 of these things seem entirely possible. Now, whether they're likely or not, we're not quite sure, but they definitely seem possible. It seems possible that we would see inflation due to a surge in demand. It seems possible we'll see inflation when we get back to full employment, and it seems possible that we'll see inflation because the Fed just keeps printing money. Brrr, the money printer goes round and round. Totally possible. But now, this also begs the question that what historically has happened. I mean, we looked at historically after pandemics, we see inflation. But historically, after market crashes, the picture is a little bit more mixed. So it's kind of hard to look towards market crashes. For example, in the Great Recession, 2008, we had over $800 billion spent on stimulus money, which today looks kind of skinny, but back then led to 12 years of pretty much no inflation, somewhere around 1% to 2%. In fact, inflation has almost kind of left the modern world since about the 1990s. And a lot of more modern and developed countries are more concerned with deflation than inflation. And that's also kind of weird because it seems like with all this money printing, we should be seeing more inflation. After all, you've got some interest rates in Europe that are negative. You've got Japan struggling to find inflation. The only ones who are actually fighting inflation is China, but they're not even a completely developed country yet. So what you really have here is a situation where, well, when we look back over the last 20 years, we kind of don't have a lot of inflation precedent to look at. What we do, though, have is the fact that, oh, wait, 19 years before this year, we had very low inflation and sort of normal government spending, if you could even say that, after all the quantitative easing after 2008. Then you go over to 2020, and the world produces 20% of the money that's in circulation, and we're expected not to see inflation. It seems a little odd. And so this has a lot of us wondering, okay, well, I mean, the central banks and governments, they have to be doing something to prevent inflation from happening. And ironically, when we actually look at the central banks and governments, and I say central banks and governments because, like, in the United States, the central bank is separate from the government, technically. But in China, they're not. They're combined. The government controls the central bank. So anyway, you'd think that central banks and governments wouldn't want this inflation to come, but ironically, they actually do. They want to see this inflation come. So we create 20% of the world's currency. They want inflation to come. We're not seeing it yet, but what does this mean that, you know, what's coming down the pike, so to speak, here, and what do we got to do about it? Well, first, it's helpful to understand why the government wants to see inflation. Quick example. Let's say you make $9.90 per hour and you owe $1,000 in debt on your credit card. And just for simplicity, let's say that credit card has 0% interest for a year. It would take you 101 hours to pay off that debt, not considering taxes or interest here. Well, if we had 2% inflation and your wage went up with inflation by 2%, then you'd be making $10 an hour. You'd still owe the same $1,000 because debt does not go up with inflation. And so all of a sudden, now it's only going to take you 100 hours to pay off that debt. You just saved an hour. And this compounds over time. See, the interesting thing about inflation is the more inflation happens, the cheaper the debt you already have becomes to pay off. A house bought in the 1990s, 80s, 70s is way cheaper to pay off than a house bought in 2015 because the debt just isn't worth as much to the buyer anymore as it was back then. So in some sense, it kind of seems like if you're investing in real estate, you want some inflation. And so this then kind of begs the question, do we just all go out and buy Bitcoin to hedge ourselves from inflation, or do we go buy a bunch of real estate, or, you know, is there even going to be a lot of inflation? And this is where it's helpful to look at The Economist and see what The Economist believes is going to happen in terms of inflation. In the latest weekly publication by The Economist wrote that they don't actually see real inflation coming despite this insane money printing we've had this year until we absolutely get to full employment and we get wages starting to go up. The problem, they say, though, is as people are getting older, usually people would retire, but people are aging healthier these days. You know, ignore the pandemic for a moment. And this actually, in a weird way, means even though we think we're going to get to 2023, 2024 full employment, because people are working longer and they're not retiring as soon so they can continue to make money, we might actually not see that pressure on wages going up as we get to full employment in 2023 or 2024. And that's mostly, again, because people are healthier and wanting to work longer. And so The Economist actually thinks solely by looking at the potential for worker shortages causing wages to go up, leading to inflation, The Economist thinks we might not see inflation, ironically, despite all of this insane money printing. So you're really in this weird situation where you've got economists saying, we're not seeing inflation and we don't think we're going to have a lot of long-run inflation. Yet we have the data that 20% of the world's currency was just basically created out of thin air in a matter of 11 and a half months, which is very weird. And we would expect to see inflation, but we're not. Well, at the same time, we look at modernized countries like Japan and we're like, hey, you know, you guys are stimulating and pulling debt like crazy to try to get inflation happening, but you're not making it happen. Europe's not making it happen, and nobody's really getting the inflation to come around. And so all around, we think that we should see inflation, yet we're just not seeing it. And we're sort of in this weird situation where we sit here wondering, okay, well, what do we do? I mean, do we hold on to the pieces of paper that say, trust me? Or is there something that's better to do that protects us whether there is inflation or there isn't inflation? And in this case, the answer is there is. The answer is when you invest in assets like stocks or real estate, you generally ride the wave of inflation in excess of whatever inflation is. So this is kind of important to know. So think about this. When you invest in stocks and real estate, obviously they go up and down in value, and they tend to trend upwards. Well, let's say that this is the inflation line, the blue line here. The value of your stocks and your real estate, properly diversified, tends to grow in excess of whatever inflation is. So if inflation down here is negative 0.5%, or over here it's 2% or 3% or 4%, the value of your assets tends to go up on top of whatever inflation is. And this is kind of good to know because this means you are protected in some sense from whatever inflation does by investing in assets like housing or real estate. Now the problem is, in the short term, when inflation goes up and interest rates go up, you could see a short-term dip in real estate prices because borrowing gets tighter. And so really, inflation, you gotta almost see it as like, in the short term, it can be painful for stocks and real estate. In the long run, real estate and stocks tend to float on top of whatever inflation is. And so that really becomes a case for, oh, okay, so no matter what happens with inflation, we should consider investing because we're on sort of that wave, the ups and downs, so to speak. And if the Fed doesn't think that we're going to get to full employment until 2023 or 2024, then we're probably not too worried about actually seeing interest rates go up until 2023, 2024 at the soonest, which would mean that we're probably going to be insulated, at least for the next few years, from any kind of price shock to real estate from interest rates going up. There are other things that could push real estate down. You know, we could see an eviction crisis. There are many other things that go on that could affect real estate prices or even stock prices, individual stock prices certainly. But the other thing that we can do is we can take on modest amounts of cheap debt to protect ourselves. Remember that credit card example I gave? The best form of a credit card against your investments is really a 30-year fixed rate mortgage against real estate. I personally don't recommend prepaying your mortgage until you're ready to retire or getting close to retirement. And that's because you could lock up money at 30 years for a fixed rate, sometimes as low as 0.75, 2.5% these days, which is ridiculously low. And you're locking in this interest rate for 30 years. And if for some reason there's this crazy pandemic that happens, the banks might just call you and go, hey, we'll offer you a mortgage forbearance if you can't make your payment, which is also kind of insane. But anyway, it definitely makes sense, despite or sort of in spite of what happens with inflation, whether it goes up or it stays down in this weird environment we're in. It definitely makes sense to get invested and have at least some exposure to safe debt. You don't want to be over leveraged. You want to keep your leverage relatively in control without a doubt. You know, in stocks, I recommend 0 to 10% leverage, 0 to 20% leverage, maybe. Stock leverage is just dangerous, so be careful there. In real estate, I like to be no more than 60% debt. If you get to half-half, that could be nice. There's a balancing act to do there. But these are some things to consider about what central banks in the world are doing right now relative to what our inflation expectations are and relative to what we should do about it. So I know this was a little bit more of a high-level video. If you found it helpful, though, consider subscribing to the channel and checking out the programs and the links down below. My goal is always to provide you perspective that helps you build your wealth. And of course, if you haven't yet, make sure to get 4 free stocks with Webull. Deposit $100, get 4 free stocks worth up to $1,600. And at minimum, $21. Also, there is a link for life insurance right next to that, and folks, we'll see you in the next video.